I can see. So good afternoon, everyone. Welcome to our session for IFRS 18. The webinar is organized by UAE Chapter of ICAP members. And we have brought to you some of the industry experts on this outstanding and interesting topic today. This is not just one change in the IFRS or just an introduction to the new IFRS. IFRS 18 brings a substantial, or basically I would say a fundamental change in the reporting manner. So I think that would be very important for all the finance professionals. And today we have a number of speakers with us. And I would like to introduce myself. I'm Khushbu Mushtaq, Chartered Accountant by profession and the chairperson of the UAE chapter of ICAP members. We have with us some of the distinguished speakers at this point of time. We have with us Mr. Paul Callaghan. Paul comes from an outstanding background, very inspirational person, very intelligent, I would say. I've been following him for quite some time, Paul. So quick introduction about Paul. Paul is a partner, head of advisory and global head of energy sector at Moore Stephen LLC, Oman. The second speaker that we have is Ms. Payal Chandnani. Payal is also an IFRS expert. Payal comes from KPMG Lower Gulf. She's handling the position of principal at IFRS Technical Desk. And she will help us to go through the practical implementations of this IFRS. And there is one more speaker who will join us shortly, Mr. Khalilullah Shaikh, who is the IFAC's board member. So he will also give us some idea about the overall or the global perspective of standard setting. So without further ado, I would like to invite Paul to take up, and he will give us the background about the conceptual framework, what standard brings to us. Paul, over to you.
Sure, and hopefully you can hear me okay.
Yes.
No, great. Well, first of all, thank you for your very kind introduction. You're very kind and generous. It's a privilege to be here and to be presenting to such a prestigious institute's UAE chapter. So thank you very much. Hopefully I can get the technology right and share my screen.
Yes, please share your screen and you can take up.
All right, excellent. Thank you.
Just one thing I would like to share with my attendees. If you would allow us, we'd like to take the questions at the end. So let Paul take up the charge for the topic that he's taking up. Okay, thank you. Over to you, Paul.
Thank you. Can you see my screen? Can you see the slides?
Yes, we do.
Okay, good. I'm a bit technologically challenged, so thank you. Well, obviously IFRS 18 is an interesting standard, and it's actually a little bit more complex than we all may have thought initially. So I'm just going to go through some key requirements and practical implications, just to share with you. And in my spare time, many of us are the same. We wear many hats. So I'm also a member of the more global IFRS steering committee, and we've been spending probably about 1 year looking at IFRS 18. So it's not as simple as it seems. But let's get cracking. So IFRS 18, presentation and disclosure of financial statements. What's it all about? Well, really, it's been developed by the IASB's Primary Financial Statements Project, and I think we're probably going to hear more about that from a very distinguished speaker later. And it replaces IS1, Presentation of Financial Statements. It's effective from the 1st of January 2027. However, it's retrospective. So in other words, corresponding figures for comparative purposes for 2026 will also need to be adjusted for this presentation. It actually affects, I would probably say, every set of IFRS financial statements to some degree. There are issues which we were going to go into, and it actually does require quite an element of judgment, and it's not as straightforward as we may have thought. It's not just jiggling a few numbers on the face of the income statement. Three key changes: presentation of the income statement, the introduction of something new and something which is going to be quite challenging, I suspect, management-defined performance measures requiring disclosure, aggregation and disaggregation of the amounts disclosed in the financial statements, and especially the primary statements and the notes, of course. We will come into each of these in detail. So what's the difference between IFRS 18 and IFRS 1? Currently, IFRS 1 only prescribes minimum line items for the profit or loss section. This will undergo quite significant changes in IFRS 18. It also gives a structure for other comprehensive income. That's not changed under IFRS 18. IFRS 18 prescribes 5 categories and various subtotals that have to be presented in the statement of profit or loss. But again, the statement of other comprehensive income does not change under IFRS 18. So what are the 5 elements of IFRS 18? Oops, hold on. Okay. The income and expenses in the income statement or the P&L statement are now split between operating, investing, financing, income tax, and discontinued operations. In terms of subtotals, you're going to have operating profit, profit before financing and income taxes, profit before income taxes, profit from continuing operations, and net profit for the period. Now, this probably feels similar to the cash flow statement, but it doesn't align in all aspects. There are some differences. Equally, when implementing IFRS 18, there's some considerations that we have to think about. The time and effort required to, remap the income statement, the profit and loss statement, to fit in with the new standard. The chart of accounts may need to be changed, enhanced, added to, edited. The ERP system may also need some fine-tuning potentially. Where there's a group, obviously subsidiaries are going to have to align from a group perspective as well. And consequential impacts, debt covenants based on certain IS1 existing IFRS descriptions and numbers may need to be renegotiated and changed to be in line. KPIs and remuneration based on the existing P&L numbers could be affected and may need to be thought about. The key here is communication of impacts and potential impacts to all stakeholders, not only investors, but also management, directors, and financiers. That's quite important. There you go. That's what we said. Not in line with the cash flow statement exactly. The key for IFRS 18 income statement presentation is what is the main business activity of the organization. Let's dig in a little bit to some of these. Starting off with investing. Income and expenses relating to associates, joint ventures, unconsolidated subsidiaries, cash and cash equivalents, usually with some exceptions. Other assets that generate returns independent of or largely independently of other resources, they will tend to flow in the investing category. Let's have a bit of a closer look as to what would be included and what would not be included generally in investing. Included, rental, property-related amounts, unless renting property is a major business activity, then it's going to be an operating. Share of associates and JV profit, dividends, interest income on debt instruments, and transaction costs on buying and selling these things. What would normally not be included in investing? Property, plant and equipment related amounts, impairment of trade receivables, discontinued operations. That's going to come on discontinued operations, obviously. Business combination related amounts, bargain purchase gains, remeasurements of contingent consideration. Important to note, one of the pitfalls is investment property you'd think of as being investing, right? Well, if it was the main business activity, no. It would be in operating activities. Property, plant, and equipment generally, for example, in the cash flow statement is considered investing. But here it probably wouldn't be. It would more likely be operating. Yeah. What about financing? Let's have a quick look at financing. Obviously, you're going to have liabilities which only involve the raising of finance. But the standard also requires identification of other liabilities which do not only involve the raising of finance. Those are a little bit less obvious. So payables for goods or services that will be settled in cash, contract liabilities, lease liabilities, defined benefit pension liabilities, decommissioning provisions, litigation provisions. Interest income and expense and the impact of changes in interest rates affecting these will also be included in financing. So just as a summary, what's generally going to be in financing? Loan interest expense, gain or losses on extinguishment of a loan, dividends on instruments classified as liabilities, interest expense on provisions, net interest expense on net defined benefit liabilities, lease liability interest expense, and interest on contract liabilities or contract assets. However, changes in the expectation of amounts required to settle a provision, current and past service costs for defined benefit plans, short-term low-value leases, in other words, where there's no lease liability and right of use asset not included. Remeasurement of contingent consideration for a business combination, again, would be excluded from financing. Excuse me. On to a slightly easier one. Income taxes. Income and expenses calculated in accordance with IAS 12. Any associated foreign exchange gains or losses will be classified as income tax. A little bit of a question here. Where to present the effects from deferred taxes on PP&E, which is operating, or investment property if it's in investing categories? Seems like, is that a complicated question? No, not really. It all goes in tax. So tax is tax. This is probably the simplest area of classification under IFRS 18. Now the biggie, operating. Basically, this is a bucket category that fits everything that doesn't slot into all the others. But generally, you would go through everything to see, is it investing? Is it financing? Is it tax? Is it discontinued operations? And whatever's left is going to flow into operating. Key question, what is the main business activity which drives this? As you'd expect, expenses can be categorized either by function, nature, and in some circumstances, a mixed presentation, which is pretty similar to what happens now, yeah. Sorry, bear with me a second. So generally, operating is income expenses relating to property, plant, and equipment, intangibles, business combinations, impairment of trade receivables, amortization of right of use assets. Any income and expenses also relating to the main business activity or those which have not fitted into the other categories, or where there are exceptions where you can opt to choose operating, which we're going to come on to some of those now. Interesting example of classification just to look at. So income and expenses relating to an investment in an associate or a joint venture. How are we going to classify those under IAS 18? If it's under the equity method, then generally it falls within investing category. If they're carried at cost or fair value, is that the main business activity? So in other words, if it's an investment entity. If no, it's investing. If yes, it's operating. That one wasn't too difficult, so we move on, hopefully. What about income and expenses from cash and cash equivalents? Well, generally it falls under investing. However, it depends and exceptions under IFRS 18. So if the main business activity is investing, largely independent of other resources, it's going to be operating. And here's another one, unless it's financing provided to customers as the main business activity. Then if it's related to the financing, it would be operating. If it's not related to financing, then it's accounting policy choice. You can choose to put it in operating. There you go. And if you can't really tell, it's operating under all these unlesses, yeah. But the default category for income and expenses on cash and cash equivalents will always be investing, with exceptions. Okay. What about income and expenses on derivative instruments? If it's applying hedge accounting, those income and expenses will be classified as income and expenses from the hedged item, or sorry, those items, unless it's grossing up of gains and losses when it flows into operating. If it's used for risk management but no hedge accounting, generally the same category as the income and expenses affected by the managed risks. However, unless it's undue cost and effort to do that, or it's grossing up of gains and losses, yeah, it's going to be operating, yeah. Sorry, oops, my mouse is getting a bit excited. Sorry about that. Let's have a look at some questions that you might have. The answer to all these questions, there you go, I'll spoil the fun. It depends. So what is the appropriate classification of gains and losses on a group of assets and liabilities classified as held for sale? And ultimately, the gain or loss on sale. If it's part of discontinued operations, it goes in discontinued operations. If not, it depends on whether the disposal group was in the operating category or the investing category, and the income and expenses would then be classified accordingly. A little question, what's the appropriate classification of foreign exchange gains or losses on monetary items? Again, classified as the same category as the income and expense that gave rise to the FX difference, unless there's undue cost and effort in doing so, in which case you just keep it under operating as a default. A little question, what's the appropriate classification of gains or losses on derivatives that are used to manage risks and designated hedging instruments? It's the same category as the income and expense affected by the risks that the instrument is being used to manage. Again, unless it involves grossing up of gains and losses, in which case it's under operating category. Very quickly, I won't go through this in detail. This is just a reminder of what we've looked at. 5 categories: operating, investing, financing, income tax, or discontinued operations. You also have to show operating profit, profit before financing and income taxes, profit before income taxes, profit from continuing operations, and net profit for the period. Some of this looks like the cash flow statement, but it's not. There's some consequential impacts on KPIs, covenants. You need to think about the time and effort to remap. Chart of accounts may need to change. What about a group structure and subsidiaries? Communication is critical to everybody. IFRS 18 also introduces management performance measures, MPMs. This is basically a subtotal of income and expenses, which is used in public communications outside the financial statements, used to communicate management's view of an aspect of the entity's financial performance, but is not required to be disclosed under IFRS. The financial statements in one note have to disclose the purpose of the MPM and its calculation methodology, a reconciliation to the closest amount or measure required under IFRS. And again, all MPMs have to be disclosed in a single note. This is designed to improve transparency. However, this is not the same as alternative performance measures within the financial statements, such as EBITDA, so forth. The key question here is, what is a public communication outside the financial statements? Now, some of these may be a surprise. Management commentary? Yes, it is. Press releases? Yes, they are. Investor communications? Yes, they are. What is not considered a public communication under IFRS 18? Oral communications? Written transcripts of an oral communication? And what I found was quite interesting. Social media posts are not considered public communications. Now, only public communications in the reporting period should be considered in identifying MPMs for that period. However, if they routinely issue such public communications after the date of issue as financial statements, they might want to think of those relating to the prior period and use them to identify MPMs for the current reporting period. So there's a little bit of work required there. I was a bit surprised by social media posts, given how people operate today, but there you go. The other aspect introduced by IFRS 18 is aggregation and disaggregation. Primary financial statements, as you'd expect, are to provide a useful structured summary of the reported entity's assets, liabilities, equity, income, expenses, and cash flows. And the notes are to provide material information to enable users to understand the items in the primary financial statements and give supplementary information designed to meet the objective of financial statements as prescribed by the IASB. So in other words, that requires a classification aggregation of items based on the same material characteristics, and those where those are not shared, disaggregated. Now, this requires judgment and obviously the overriding principle of materiality, so not so straightforward. For those of us who are preparing financial statements, along with auditors of those financial statements, IFRS in issue prior to adoption, not yet applied, do need to be disclosed. Very often, you'll find a statement in financial statements saying that these are the new IFRSs, and we don't think any of them are going to have a significant impact. I would challenge that on IFRS 18. It's going to affect all financial statements, even if it's just presentation. The structure of the P&L is almost certainly going to change. So clearly there will be an impact. Covenants will be impacted. Bonus accruals based on profit measures, how are they being calculated? Share-based payment arrangements, will they change and be affected? You know, the big question, what are the main business activities which drive operating activities? Are there any management performance measures, MPMs? If you're an auditor, how do you audit them? What about completeness? A lot of practical application issues to be addressed. There is a lot of judgment under IFRS 18, which initially people may not have thought about. Again, some more implications for preparers and auditors. A few kind of questions here. Would a private company ever have public communications outside the financial statements? Could they have MPMs? Perhaps. What are the differences in the presentation of function versus nature versus mixed from IS1, if any? How do you calculate the income tax effect of reconciling items for MPMs back to the closest IFRS measure? That could get a bit interesting. How do materiality and aggregation, disaggregation work together? How do you determine whether something is material or not? How do you measure it? Gains or losses held for sale? How is it categorized across investing, operating, discontinued operations? What is undue cost and effort when it comes to tracking FX to the underlying transactions? Again, a lot of judgment there. There's going to be a lot of application questions for an entity starting to implement and assess the impact of IFRS 18. I would strongly recommend that preparers of financial statements start looking at this early. There are published guidance already coming out to support you on IFRS 18. And one of the speakers is from a firm I worked with for 23 years, and was a partner in, so she'll be quite happy to see KPMG's guidance being shared there on the left. Obviously, there's going to be a lot of questions which may arise now, at the end of the sessions, later. So I wish you all well in implementing or auditing IFRS 18, and all the best. Thank you very much.
Thank you very much, Paul. Yes, we do have few questions. I suggest we can take it at the end, because I think half of those might be answered during the other speakers. But thank you again for sharing your insights on the conceptual framework and the changes. I understand it's a huge impact that will fall on the financial information, most probably the profit and loss account. Why? Because because I myself implement IFRSs on many of my clients. So I know my clients are just coming up to me, how we are going to implement, what are the changes, how will it impact my organization. Some of them still say that it does not have any impact on me, but I think with the Payal on board, maybe most of the questions will be answered. I just want to share one thing, what I came up with, the point that you have raised about MPMs. So I think this would be a very good initiative that IFAC is imposing on all the entities, especially where the users are investing in those companies. So, for example, if there is an EPC company, any construction company who currently have no contracts as of now, or the contracts are about to end, let's say. So in that entity, in that company, if they have signed a few contracts and they can disclose the future contractual information or the signed up contracts with their users, I assume that will have a greater confidence to the users, ensuring that, okay, this company, the investment that we have done is not going into vain. The company is going to gain X amount of revenue over the period based on the contracts that has been signed, because those signed contracts are not shown anywhere in the financial statements. Not your liability, not your asset, but this could be treated as a MPM, a performance measure, other information that will help a user of the financial information. So I think this is a very good initiative, which globally many investors and regulators have been raising concerns in the past that the information or the P&L is becoming redundant. There is no comparability. So I think this change in the presentation might have a good impact for only the users. I'm sure it will be a little bit hectic exercise for the organization, but I think it's a one-time thing. Once you are done, it will be only replicating the information every year. So thank you very much, Paul. It was very nice. And before, I think I have the other speaker as well, Mr. Khalilullah Shaikh has already joined us. Thank you, Mr. Khalil. So the second session we have is of Ms. Payal. Hello, Payal.
Hi, Khushbu.
Hi. So Payal, again, as an introduction to the attendees who have recently joined, Payal is working at KPMG. She's a principal at IFRS Technical Desk. I think one of the most prestigious position, IFRS Technical Desk. So Payal, thank you very much for joining us. Payal will be taking us through the practical implementation, industry impact, and readiness roadmap for IFRS 18. So most of the questions that I can see on the chat, on the Q&A box, I think most of them will be answered. Payal, over to you. Thank you very much.
Thanks, Khushbu. Give me a minute to just bring up the presentation.
Of course.
Yes, and I hope this is now visible.
Yes, Payal.
Okay, great. So firstly, it's a pleasure to be addressing the UAE chapter and all the ICAP members. It's a great opportunity to be interacting with all of you. So thank you for that. We will talk a little bit, and thanks to Paul for giving a great introduction to the subject. What we'll do is we'll take each of the items that Paul spoke about, and maybe I'll try and share some practical experiences, challenges associated with implementing those changes. So for starters, there are very In fact, I was told there are possibly only 2 or 3 companies globally that have early adopted this standard. Just to share with the members, because it's always useful to see something in practice and financial statements rather than just hear or read about it. So for those who are interested, we actually have a company in the UAE that has early adopted this standard, and those financials are publicly available, which is of a telecom company called Do, for which in fact KPMG are the auditors, and we have been closely working with them for reviewing their quarterly accounts. Obviously, the annual is yet to come, but even at the interim levels, we have been involved in the review of their early adoption of IFRS 18. So if anyone wants to look at a practical set of financial statements where IFRS 18 has been early adopted, I would recommend you take a look at those. So the first and the foremost thing, as we just heard, was that the income statement is going to be divided into 3 categories, which is the operating, the investing, and the financing category. And like Paul rightly mentioned, it might remind us of another primary statement, which is the cash flow. But we all know that in order for our profession to be interesting, if we keep this the same as cash flow, right, it's less exciting and less work and less importance for our profession. So the ISB has tried to, as usual, keep things interesting, fun, complicated, whatever word you may want to choose. But let me illustrate one example just to give you a practical experience of how this is different from the cash flow, right? So let's take one example. So when you sell a PPE, right? When you sell PPE in the cash flow statement, we have something called proceeds from sale of PPE, which are generally reported in the investing category of the cash flow, right? So if you sell a PPE, sales from PPE comes from the investing category in the cash flow statement. Now let's come to IFRS 18 and let's come to the income statement. As per IFRS 18, obviously in the P&L, you won't have proceeds from sale of PPE, but you'll have gain or loss from sale of PPE. And as per IFRS 18, that will not sit in the investing category. Rather, it will sit in the operating category. So that's a great example for all those on call to practically understand what are some of the differences that would happen between the cash flow and the P&L. Now, the example that I just gave, let's try to unpack why this is the case, right? So now, as per IFRS 18, the things that go into investing categories relate to those assets that generate an independent return. So if you think about it, a PPE could be something like a single piece of machinery. It could be a head office building, which is classified as PPE. A single piece of machinery never generates money on its own because it is working in tandem with your other pieces of machinery, your factory, and together producing revenue. So it is not an asset that produces income on its own, which is why it won't come in the investing category. It would go into the operating category. So what would come in the investing category? What is an example of an asset that generates independent return? The example of that would be an investment property. Investment property, it's basically a land and building which you can just rent out. You may be a manufacturing business, but this investment property is not linked to your manufacturing business and it's generating money on its own independently because all you have done is rented it out and that's it. There's no dependency with the rest of your assets. So that's an example of an asset that generates independent returns. And the gain or sale of an investment property would come under the investing category, but a gain on sale of PPE would go into the operating category. So you see, these are the ways there are differences between different asset types going into different categories, and also an illustration of how the P&L looks different from the cash flow. Now, let's take let's make this the aim and the mandate I've been given is we want to keep this practical. So let's take this example forward, right? Now, let's say I just explained that the gain on sale of an investment property would go into investing category. Let's say we are talking about a company that's only business is to have investment property, rent them and sell them. That's all. That's all the company does, which is basically it's an investment property holdco. Now, if you go by the logic that I just explained, what would happen is the entire P&L of this entity related to investment property, which is all the rentals, the gain on fair value remeasurement, the sale on investment property, any gain or loss, would go into the investing category. So do you think that is a good representation of the entity's business? Answer is no, because though investment property might be investing in nature for a company whose main business is something else, but for this company, it's the bread and butter. And if for this company it's the bread and butter, it will move out of investing and go into operating. So this is what Paul was talking about, exceptions. So the general rule stands, but if you are in businesses which are specified main business activities, there are things that go out of investing, out of financing, and into operating category, right? Now, when I say that there are exceptions, are there exceptions? So one exception we just saw in the example was an investment property company. But are there other business models where this exception can apply? So the standard says yes. The standard says that I will be bifurcating all companies into a couple of parts, and only two types of companies will be eligible for these types of exceptions. So what are these two types of companies? One is if your company's main business activity is investing in assets, then because we don't want all of their income to sit into the investing category, you have this exception available to you where things will come out of the investing category and go into the operating category. The second type of companies that will be entitled to this exception are those that provide financing to customers, right? Those that provide financing to customers. So let's think about a bank. What does a bank do? It gives loans and it takes loans. So if you follow the general principle, all the interest expense will go into financing, all the interest income might go into investing, if this exception was not available, which would make no sense for a bank, right? Because for a bank, giving loans and accepting deposits is part of their operations, which is why if you are a bank, a lending institution, there is an exception available to you to reclassify all of these interest expenses and income into the operating category. So these are the two types of entities which have certain exceptions available to them, where things would move out of the investing and financing category and go into the operating category, which I'm sure all of us agree is a very logical thing to do for these kind of companies. Otherwise, their P&L will really not look great and will not make logical sense. So those are two practical examples. Let's look at a few more, right? So let's take one by one these examples and see whether they fall into the definition of the exception category of companies that we just spoke about on the previous page. So a car manufacturer that manufactures and sells cars, it's not providing financing to its customers, it's not investing in assets, so there are no exceptions available to it. A bank whose main business activity is to issue loans, yes, of course, there are exceptions available to it. An investment property company whose main business activity is only to do with those investment properties, yes, there are exceptions available. Let's take the car manufacturer again, and all of us will know this from practical experience. A car manufacturer not just produces and sells cars, it will also provide you an auto loan, it will also provide you with leasing options. So to the extent that it is providing with those auto loans, and you perform an assessment and conclude that providing those auto loans is a main business activity for this company, yes, even for a company like this, though it's not a bank, it's not an investment company, but as a part of its business, an important part of its business is to issue auto loans, exceptions will also be available for these kind of companies. Lastly, we talk about a financial conglomerate where it is involved in the business of issuance of loans. Of course, again, almost like a bank, there will be exceptions available to these kind of industries, companies in these kind of industries. Now, the other interesting bit that we have experienced when we're doing any practical implementation of the standard. Now, all of this that we've spoken about sounds very simple, as long as you're one company doing one thing, right? But we all know that that's not the way things work, right? So think about a huge company, right? Let me give you some examples from the UAE landscape. Think about a Majid Al Futtaim, right? They also have Carrefour, they also have Magic Planet, they also have the malls in which they lease spaces to so many people. Think about an Emaar. The Emaar also has real estate, also has Emaar malls, also might be providing financing to its customers to buy the real estate via deferred payment plans. So you have companies which are huge conglomerates, huge groups where different companies are doing different things. So the one thing we must remember is there might be a company who envisages that its main business activity is something. When that company gets consolidated into a part of a bigger group, for the group, that subsidiary might be extremely small, and that might not be the main business activity for the group. So, what this again leads us to one practical implementation thing, which we must all bear in mind is, whether we are auditors or whether we are working in the industry as part of big groups, the reporting that you receive from your subsidiaries and components cannot be directly consolidated into your accounts. Whatever your subsidiary shows as financing, operating, and investing may not exactly be operating, investing, and financing respectively for the group accounts. So that is another maybe a blind spot that one could have, which one may miss, which needs to be assessed at every level of consolidation before just automatically taking the classification from the underlying subsidiaries. Yeah. Paul already displayed this, and yes, Paul, indeed, I was glad that there was a KPMG publication on your slides. So what the slide is trying to do is it's trying to illustrate that the same item might be classified differently for different types of industries. Let's take an example. Interest on cash and cash equivalents, almost there in every company, because what do companies do? Whatever excess cash they have available with themselves, at least they will make a bank deposit. At least they'll make a term deposit out of it. And what happens with the term deposit is you earn interest out of it. Now, what you'll see on the very first line here is that for some companies, it appears as investing. Some companies, it changes to operating, right? Why and how? Okay. So for a normal company, which is simply involved in manufacturing, trading, a very plain vanilla business model, which does not involve investing, and a business model that does not involve providing finance, any interest that you earn on your fixed deposits would be an investing activity. But let's say you are not just manufacturing goods, you're manufacturing goods, and to your customers, you're providing deferred payment terms. And let me link this with IFRS 15. You have a significant financing component. So if you have a significant financing component, it means you're providing finance to your customers. It means this manufacturer now comes into the exception category. And if it comes into the exception category, because you're providing finance, this interest income might actually be classified as operating. So if you see, you could have one manufacturer have interest income as investing and another manufacturer having interest income as operating. And that's the beauty of the standard, right? I'll take one more example, and Paul briefly touched about it as well. And let me tell you from my experience in the market, this is not something people or organizations are very happy about, right? Which is basically your associates and joint ventures. Now, the most common accounting for associates and joint ventures is to equity account for them. Yeah? When I say equity account, you pick up the share of results, unless you're an investment entity at which you will carry it at fair value. Now, what the standard says is any share of results that you pick up on your associates and JVs cannot be part of operating activity. You can't even argue that investing is your main business activity and hence you should have an exception. The exception does not apply to this line item. So if there are companies out there and the way they do business is by getting into associates and JVs, unfortunately, their operating profit is suddenly not going to look great because there are no exceptions to the rule that if you equity account for your associates and JVs, irrespective of whether investing is your main business activity, this cannot be a part of your operating profit. This is important to understand because if you have any banking covenants linked to operating profit, because the definition of operating profit has now suddenly changed, and you know that there are certain things which earlier were part of operating profit but now won't be, which will make it difficult for you to meet those covenants. The time is now for you to have those conversations with your banks in order to renegotiate what the covenant should be to avoid failing them, right? I think Paul already spoke about this, so I'll skip to the next. Okay, as far as within the operating category is concerned, so far under IS1, there were only two types of presentations that were allowed. One was by function. When I say by function, that would be like general and admin, sales and distribution. One was by nature. By nature, when I mean payroll, depreciation, advertising, that's what I mean by nature. What IFRS 18 does is it makes our lives a bit simpler. So great, there's something that's getting simpler. It said even a mixed basis of presentation is allowed, which means you don't follow strictly function, you don't follow strictly nature, but you can mix those two, have some things presented by function and some things presented by nature. Of course, whenever the standard allows anything, it also introduces disclosure requirements. So if you choose to go down that route, just be careful that there will be additional disclosure requirements that will apply to you. Yeah. What will be those additional disclosure requirements? Those additional disclosure requirements would be that if you choose to not show these 5 expense categories on the face of your P&L, okay, because you're not showing depreciation on the face of the P&L, rather you're showing general and admin, sales and distribution and direct cost. Basically, depreciation is sitting hidden in each of these line items, right? So what the standard wants you to do, it wants you for these 5 expense categories, which is depreciation, amortization, employee benefits, impairments, and inventory write-downs. It wants you to give the total amount. Take the total amount, tell the reader how much of it is sitting in operating, how much of it is not sitting in operating. How is that possible? So a depreciation of PPE will sit in operating, but a depreciation of investment property, if you're choosing to go with cost model, will sit under investing. So tell the user how much of this depreciation is in the operating versus investing category. Within operating, where is this depreciation classified? If it relates to the head office, it will be in general and admin. If it relates to the manufacturing factory, it will sit in cost of goods sold. So you give the breakup of where each of these is included as part of a disclosure in the financial statements. Paul also spoke about management performance measures. And yes, the interesting part here is that, and Gen Zs may not like this, but social media posts are not considered to be a source of management performance measures. And to be honest, this is for good reason. I mean, think about someone like Elon Musk, who's maybe tweeting every day on LinkedIn about his company. We as auditors will probably need to spare one person in the audit team to every day wake up and see whether there are any management performance measures coming out of it. So for good measure, social media posts are not considered a source of identifying management performance measures. But the other thing I just want to touch upon as far as management performance measures are concerned, and it's a common misconception that anything and everything which is communicated as part of an annual report or a management commentary is a management performance measure. The answer to that is no. IFRS 18 has a very specific definition, and that definition says that only subtotals of incomes and expenditures are management performance measures. What does that mean? That means carbon emissions, which are mentioned in annual reports, are not management performance measures because they are not subtotals of income and expenses. Return on asset, which is a ratio, it is not a subtotal of income and expenses, and it is not a management performance measure. Something like adjusted revenue is again not a management performance measure because it's only income. It's not a subtotal of income and expense. Something like adjusted operating profit, adjusted EBITDA will be a management performance measure because it is a subtotal of income and expenses, right? So it is important to ensure that we get the definition right because you don't want to end up identifying more management performance measures than needed because then your disclosure effort will go up in the process, right? Just one last thing I want to say about this. I don't want people to think that IFRS 18 is only an income statement or a P&L standard. It has also introduced some very minor, but definitely some changes even in the balance sheet and the cash flow. I'll just touch upon these very quickly. As far as the balance sheet is concerned, goodwill, if you have goodwill and that number is material, is required to be presented on the face of the balance sheet. Right now, we don't do that. We put it under intangible assets and it's totally okay, but not anymore. So if your goodwill is material, it will need to be presented on the face of the balance sheet. As far as the cash flow is concerned, there are a couple of changes. So in your operating activities, the starting point right now is like net profit. But with IFRS 18 coming in, the starting point of your operating activities would be the operating profit, not the net profit. The other important change introduced as part of cash flow is for interest paid. Currently, we have a choice available. We can either put interest paid in financing or operating, interest received either in investing or operating. This choice has been taken away. So interest paid can only be in financing and interest received can only be in investing. The operating option has been taken away. And that is the same for dividend received and paid as well. So just last thoughts from me, big ticket items. Remember that if you're part of a big group, what happens in your subsidiaries cannot directly be consolidated upwards. You will have to spend some time in choosing how to present your expenses, whether by function, by nature, by mixed. But make sure, don't forget that there would be additional disclosure requirements applicable, and you may need to enhance your chart of accounts mapping, etc. So please ensure that you realize that there will be some time and investment needed as part of this entire exercise. So thanks. That was all for me, and I'd be happy to take any questions if there are. Thank you.
Thank you very much, Payal. It was a very extensive, interesting session. I'm sure the audience would be loving it. The examples that you have shared are real life examples. The one that of investment property is actually a scenario at my client, so I can actually relate. So, and the last point that you have made, although it looks like a small change, but I'm sure when the people will start implementing, it will definitely be, no, I'm sure it'll give them a pain throughout with the auditors, and I feel bad for the auditors. Their work has increased, especially the MPMs. I remember the ISA used to say that you have to review the other information that the company is disclosing in the financial statements, along with in the director's report and wheresoever. But now the MPMs have to. It's a part of audit, and you have to give an audit opinion on that. That is something
Big.
yeah, I don't want to say, but yes. So thank you very much. I think it was an interesting session. I think we have few direct questions. Maybe you can respond to them one by one before I move to the third speaker. So should I call them off for you?
Yeah, sure.
Okay. So I think there's one gentleman asking about, for an entity whose main business is acquiring, managing, and disposing of investments in associates and JVs, especially a private equity model, should equity accounting income be classified in operating or investing?
Yeah.
IFRS 18 says investing is for returns from investment, but somewhere it says investments. What's your view?
Yeah, I every training session I've taken, and in November, December, almost I've taken 8 on IFRS 18. This question always comes up, so that's a great question, and thank you for that. Now, unfortunately, like I said, if you are accounting for your associates and JVs using equity accounting, even if that is your main business activity, you will not be entitled to exceptions, and this cannot be a part of operating profit. If you are in a venture capital model or an investment entity model, and you are able to measure your associates and JVs at fair value, and you prove that investing in these assets is your main business activity, then you could take it in operating. But if you're doing them at equity accounting, the story is sort of over. There are no exceptions then available. I hope that answers that question. There has been a lot of investor feedback on this because, like whoever's asked the question, there are a number of companies out there the way they do business is by forming associates and JVs, and they are feeling extremely bad because their operating profit isn't going to look healthy. But unfortunately, that is the problem we are stuck with.
And this, especially the holding companies will face this issue, right?
Exactly.
Especially the ADGMs and all. Those are
Yes.
just created holding companies. Fair enough. I think there is one gentleman, Mr. Arsalan. Would you please drop your question in the Q&As, because we cannot take individual questions like this. Just drop a question in your Q&A, please. Thank you. Then the second question is, what will be the classification of dividend income, where the main purpose of the company is to invest in local and international market?
Yeah. So if investing in main business activity, if investing is your main business activities, then the returns on some of these investments, as long as they are not associates and JVs, let me just say that, can be part of investing.
Perfect. Thank you. Okay, there's one more. For an FMCG manufacturing company with owned factories, any gain on disposal of old impaired plant and machinery will be classified under operating activities? I guess that's what you said in the start.
Yeah, yeah, absolutely.
That's
right.
Yeah. Okay. What is meant by investment in asset? What about companies that perform activities based on fund management and investments, be it funds, equities, bonds? How will this work?
Yeah. So, like I said, if your main business activity, if you're in the fund business, obviously, if you have fair value gains or losses in your P&L, that can go into operating because investing is your main business activity.
I think half of our questions are surrounding this, the only thing. I think it's a very complex thing that people are going through, especially in the UAE market, where there are a huge group of subsidiaries working within a few entities. Okay, there's one gentleman asking about basically he's asking about how will it impact banks. So if you have any idea, can you just give a quick high level knowledge that for a bank, how implementation works?
Yeah. So for a bank, it's going to be very interesting, right? Because providing loans to customers is one of the specified main business activities, which is subject to many exceptions. So what I would like to summarize the answer as, there might be things which a normal company shows under investing and financing, which for a bank will translate into operating. But again, this will need a proper assessment of your main business activity, because for some banks which are only giving out loans and investing is not their main thing, investing may not be a main business activity. But for some banks which are big on making investments as well as providing loans, they could have multiple main business activities. So there will be a lot of reclassifications from investing and financing into the operating category.
I understand. So, as a user or maybe someone who's implementing, would you recommend any illustrative example if KPMG has it on banks? Can we find it somewhere?
Yeah, it is in the process of being published, and hopefully maybe by Feb, March, we should have something in place.
Perfect. I think one of the gentlemen is asking about this. So I think just stay tuned to KPMG's website. Definitely they're going to launch something very soon. Thank you. And any more important question? I think we have already catered the expenses. Someone is asking about will there be any change on the OCI or no? Okay, the OCI will still remain the same. Someone asked about, okay, yeah, this is a good question. So is it necessary to match profits in the P&L with the starting points to the cash flow? What if our main business is to lease out property, the same one that you're talking about, but we sell some on installments. So their SFC winding and unwinding appears here or under financing. So I think they are having 2-3 businesses within one line.
Yeah. Sure. So let me answer that in parts. For your cash flow under the operating activities, the starting point will be your operating profit. So that's point number one. If you're providing SFC to your customers, then any interest unwinding would go into the operating because it becomes your main business activity. But just one caution here. Just because you provide SFC to 4 out of 10 customers, it may not become your main business activity. So you need to do an assessment whether providing this finance is your main business activity, and then you can take it to operating. Now, how do you perform that assessment? You'll have to look at board minutes. Does the board look at how much money they make out of financing? Do you have this as KPIs which get reported at the board level? Do you have an operating segment which deals with financing? These are some of the indicators in the standard which help you assess whether something is a main business activity or not.
I understand. Okay, my questions are increasing. I think most of them are repetitive on the holding companies. So I think we have already responded to the holding company side. PP is already done. Any gain or loss in change in PPE? I think Mr. Bhavesh, I think she has already responded on the first example. Once we'll share the recording, you can review those pointers again. Someone would like, okay, yeah, the same point that you were discussing about the loans. So for example, someone is asking that the loans to related party, especially in UAE, and there is an interest charge on that as well.
Yeah.
So what do you think? Will that be a part of their main business activity or no?
Yeah. So look, if you are a parent which has its own activities and you're just giving related party loans on the side, I don't think it becomes a main business activity. But if you're a parent company which is a holdco and all you do is provide financing to your subsidiaries, then the case might be slightly different.
I understand. Okay, I think most of the questions are okay. FE gain, yeah, I think this one we can take and then move there. How should we classify foreign exchange gain or losses on raw material purchases and related hedging instrument within the operating, investing, and all the categories?
Great. So for Forex gains and losses, what IFRS 18 says that the Forex gain or loss should ideally be in the same category to the item it relates. So if it relates to your operations, which seems to be the case from the question here, it will go into the operating category. If the Forex gain or loss is on loans and borrowings, it would go into financing category. If the Forex gain or loss is on an investment made in a bond in another currency, it would go into investing category. So ideally you split it. But if there is undue cost and effort involved in doing this, then you can put everything, all the Forex gain or loss into your operating category.
I think all the classifications you need to understand that what is your underlying instrument or the nature of the transaction. That will definitely help you to decide where we should classify, or maybe you can contact her personally and then engage KPMG and then take it forward.
I would
Okay,
love
that's
that.
one
Yeah.
last one. So someone wants to confirm that. So from management reporting point, basically the EBIT is equals to your operational profit.
No, EBITDA, and people have different because EBITDA is before depreciation. So depreciation on PPE would come into operating profit. So your EBITDA and operating profit most likely will not be the same.
I think that is the main purpose of this entire presentation. Perfect. Thank you very much, Payal.
Thank you.
Yeah, we have more questions. Maybe we can try to respond them on an email later on. Thank you very much, everyone. I think we'll just quickly move to the third speaker, Mr. Khalilullah Shaikh. Assalamu alaikum, Mr. Khalil.
Wa alaikum salam.
So, pleasure having you, sir. Thank you for taking out time. We are more than happy to have you, an IFAC board member, addressing the audience directly on the standard setting and what is the global perspective of the entire standard setting and IFRS and all those things. So, Mr. Khalil, I would like to invite you to share your insights on the IFRS 18 as well as on a macro level. What do you think how these standards are going to assist us as users, as management of the company? Over to you, sir.
Thank you so much, Khushbu, and very good afternoon to all the participants. Extremely delighted to be part of the session today. Wonderful discussions. I heard both Paul and Payal deep dive into the specifics of IFRS 18 and very well answering the questions as well. So let me now, I think it would be helpful if I give an overall, maybe a bit macro perspective, both of the standard setting and where is the direction of the standard setting generally, because we interact very frequently with the standard setters, the chairs of the accounting standards board, the sustainability standards board as part of a mandate and being the key stakeholders of those standard setters. So IFAC has a very strong and close liaising with them. So specifically coming to today's topic about this IFRS 18, if you look at, there are two broad themes that you would notice in the recent standard setting. And this is what Andreas, who's the chair of IASB, frequently repeats one way or the other. You would find in his presentations and in his exposure discussions, consultations. One is that they want the financial statements to better reflect the business model and tell the value creation story. And that was a demand of investors for quite some time, that financial statements are getting a bit disconnected from what the investors are looking at. And if you, from a macro perspective, from a helicopter view perspective, if you understand what Payal was trying to say, was that, all this classification of operating and investing, it depends on your business model. So the IFRS 18, what it does is, it helps you restructure your P&L based on your business model in a way that it helps the investors understand your P&L far better based on your business model. And then, of course, when you talk about MPNs and their assurance, because when an information comes in financial statements, it goes through the assurance process as well. It gives investors the real insight about the different matrices and the assurance as well of the use, the EBITDA. For example, in airline industry, they use EBITDA, right? And in EPC industry, you have got very different MBNs that are published, that are part of the commentary as well. So that's one. And if you look at another publication this year, which was the practice statement on management commentary, I see a less focus of our accountants on that. But if you look at that, and maybe it would be helpful to have a program on that. It was revised after 10-15 years. It's basically the management commentary is a narrative part. It gives a good practice guideline, a practice statement on that. And if you look at it, if you go through that, it has got 6 contents. All it is saying is tell about your business story, connect the financial statements with the strategy in the narrative part, tell you about your business model, your risk, your external environment. It has got 6 categories, starting from your business model, your strategy, your risk, your external environment, and it asks you to connect that with your financial statements, right? The narrative information. And also tell about your forward-looking information. It emphasizes significantly, because for markets, as you rightly said in one of your comments, for markets, what's more important is forward-looking information for customers, for investors. So if you look at these, this is the trend, the importance the standard settings are giving to this, how your financial statements are going to better reflect your business model and your value creation story. That's number 1 priority you would find. The number 2 priority, which we have also been pushing them, is reduce the cost of compliance, bring in simplicity where needed and where helpful. We understand that if you have got complex business model and complex business transactions, accounting cannot be oversimplified, but wherever possible. So now you look at the products in the recent years. You have got the 3rd edition of IFRS for SMEs very recently. Now, if you look at the changes in the IFRS for SMEs, what it has done is it has simplified a lot of principles around revenue recognition, around financial instruments. So IASB is trying to simplify. Yeah. They have another IFRS 19, which is about subsidiaries that do not have public accountability. They have significantly simplified their reporting requirements. So if you are a public entity and you have a subsidiary which doesn't have a public accountability, why follow the cumbersome entire disclosure requirements? They've extensively reduced those. So the focus of the standard setters, the direction is on 2 sides. Better tell your value addition story, make the financial statement more relevant for the investors, for the markets, and simplify. So that's one part of what you said is this direction. Now, where does IFAC come in this entire space? So if you look at, you've got the standard setters are independent. We had this IFRS foundation, which was established in probably, if I recall correctly, 2001, which houses the Accounting Standards Board. And since the end of 2021, it now also houses the Sustainability Standards Board, and all of the different voluntary, the fragmented landscape of sustainability standards that we had in terms of Value Reporting Foundation, SASB of USA, Sustainability Accounting Standards Board, Task Force on Climate Disclosures, they were all merged into ISSB, right? So you have got these two boards, and then the Accounting Audit and Assurance Board and Ethics Board, which were earlier part of the IFAC, have now been put into a separate organization, which is called IFIA, International Federation of Ethics and Audit. And we have gotten a public interest oversight board, ensuring that the standards meet the requirements of course, the high quality standards, but there is also a public interest oversight over that. So, and where does IFAC comes in now? Because IFAC is the most important stakeholder of these standard setters. When they set these standards, we provide them all the feedback. IFAC represents more than 180 accounting bodies of 143 jurisdictions. And we are the people who ensure the implementation of those standards through our member bodies and the members, right? We have, as part of SMOs, what we call the Statement of Members Obligations. We ensure that our member bodies follow those standards, apply those standards in their jurisdictions, and we are the helping arm. And we also provide the feedback as well in all the stages of standard setting. So standard setting starts from research phase, then it goes into advanced research phase, then it goes into an exposure draft, then it is published, then there are consultations, and then finally a standard is actually issued. And then post-standard, you have a PIR, just like for leases, IFRS 16, right now the post-implementation review is in process, because no matter what consultation you do, once you put a standard to practice, there comes questions like Payal was talking about for holding companies here, Now this is a challenge. Once they will start applying, they'll bring those challenges, and then in the PIR, you try to then, in the post-implementation review, you address those. So IFAC has got multiple groups. IFAC has got one TAC, which is Transnational Auditors Committee, where all the large firms, including the KPMG, PwC, Deloitte, and the BDO, GT, and all, which are part of the forum of firms, they are represented there. They provide their feedback through TAC to the standard setters. Then we have an SMP committee for the small and medium practitioners like Khushbu yours, right? So in that committee, we provide through that committee the perspective of the small and medium practitioners. Then we have a PIB group, which is the Professional Accountants and Business Group, where the CFOs and CEOs, the users, the preparers of the financial statements, that group gives their perspective and feedback to the standard setting. And then, of course, our PAOs, our member bodies, also provide their direct feedback to the standard setters. So it's a huge support that we provide to the standard setters in terms of the feedback, in terms of implementation, and this is how we work together.
Thank you very much, Khalil Saab. I think it's very well explained. The holistic view of how things are going in IFAC, I think most of us are not aware of, and I'm glad I have the participation of more than 300 today, and I'm sure everyone has gone through the entire structure, how IFAC works. So it's basically for our something that helps us rather than it's making problems or bringing difficulties to us. So I'm glad you explained that to us. There's one question that I would want to ask from you, basically that there is a growing discussion around integrating sustainability and financial reporting everywhere. So I want to see how close are we to seeing this become a truly connected financial or reporting model. So how are we expecting, what is the idea behind this? What do you think?
So excellent. And interestingly, I asked one of the chairs, are you foreseeing also an integrated standard setting? Because both these standard setters are housed in one organization, the Accounting Standards Board and the Sustainability Standards, and they work very closely together. And the future of reporting is about integrating the two. If you give me a minute, let me pull one slide. Can I share the screen?
Sure.
Just give me a minute. Share content. Is this screen visible?
Yes, it is.
So yeah, this is what we generally show to the non-accounting or the non-professional accounting audience, but I think this is extremely important for us as well. So if you look at IFRS Foundation, what's their meaning of connectivity? You know, when we ask them to explain it to our users, this is how they explain. You know, there are two boards. If you look at the last column, the IASB and ISSB, they both have their technical staff, their separate boards, their experts. What they are trying to do is, one is having IFRS, which are accounting standards. The other is coming up with sustainability standards. S1 and S2 we have. The two main standards which are in the pipeline, which is work in progress, is about biodiversity and ecosystems. You will see it soon. And the other is about human capital, because that's the social part of the ESG, right? So, and then what are they? The ISP is talking about financial statements and ISSB is talking about sustainability related disclosures. And these sustainability disclosures are to be ultimately disclosed in the financial statements. So there is a connectivity. Now, if you move here, look at it, that some part of the sustainability related information is non-financial, okay, but there is some part which is financial. So what do sustainability standards tell you? That they ask you to report about the risks and opportunities, not just the risks, but I'll emphasize again the opportunities about sustainability that it is creating, the ESG environment, and their impacts on your financial statement. So for example, if you are in an oil exploration and refining business, and you feel that the future EVs are going to ensure that your production from a refinery goes down, then what will you do? You will do an impairment testing on it. Now this is a risk. It has an impact on your asset and an expense on your financial statements that the standard says you have to link together. And if you are investing in renewables, and that is going to give confidence, or you are doing something in terms of your business operation and you're projecting yourself to be more environment friendly, which is attracting clientele and increasing your revenue, you have to report and connect the dots. If you are doing projects, CapEx, which is related to ESG, so that's what has to be connected with the financial statements, right? So this mid part is actually the connecting part, and this has to be understood by all of us practitioners, that this is the future of reporting. And this is one slide that I love. This is the future that you look at. You have got assets, liabilities, equity, income and expenses, the broad category, and you have got sustainability says identify your risk and opportunities. Now some risk may not have any. If you look at risk A, for example, it may not have any impact on any of your assets and income. It's okay, you will give it a narration. But there may be a risk C which has an impact on liability and expenses I just talked about. Then you have to connect it. You have to link that. It's not a silo reporting. It has to be connected. Similarly for opportunities, is the screen still available? You can see that?
Yes, we can.
Yeah. So you have to link the two. This is the future of reporting. And interestingly, I asked one of the chairs that why not think about in future coming up with integrated standards, because that would make the life of the users and the reviewers, everybody simple. But I think it's not in the near term. Maybe in the future for some elements, we might see some integrated standards as well. But this is the future of reporting, sustainability and finance together. And that is, if I chair the audit committees of 3 boards, I mean, this is exactly what I asked my CFO and CEO. I mean, tell me what's my impact on the environment and how the environment is impacting me. Tell me in terms of the financial information as well, financial statements as well. And this is what the investors are looking at as well.
Very well explained, Khalilullah. I think everyone would be delighted to know all the information that you have shared and your valuable insights. Thank you so much. I would like to thank both of my speakers as well, Paul and Payal, Would you please turn on your cameras as well so that I can have one picture with all the speakers together? Alisa, please could you stop sharing this screen?
Yeah, I'll do that.
Okay, let me fix my view. So, okay. Thank you very much, everyone who joined us today, our speakers, our attendees. I'm more than glad to see more than 250 attendees that we had today. At some point, there was 300. So thank you very much, gentlemen, ladies, whoever joined us. I hope this session was valuable to you. And thank you, our esteemed speakers, for sharing all the insights. And I hope we will connect with you soon, inshallah. All the very best and have a lovely weekend. Hopefully coming up soon. And happy holidays to whoever is going on holidays shortly. Thank you very much. Take care. Bye-bye.